welcome. You're watching NDTV Profit. I am Mahima Vachrajani. Well, Persistent Systems is in focus on the back of Q3 earnings, and we have with us Mr. Sandeep Karla, MD CEO of Persistent System, to guide us through how the quarter has gone by and what will be the forward outlook for the company. Welcome, Sandeep. Firstly, congratulations on the positive numbers. My first question to you is that you've grown your top and bottom line in a seasonally weak quarter. What are you doing right that the larger peers aren't?
So first of all, thank you for having me, and a very happy new year to your viewers. Let me first give you a high-level color on the quarterly financials, and I'll answer your question. So for Q3, we delivered $300.55 million. This represents a 3% quarter-on-quarter sequential growth and 13.7% on year-on-year basis for the reference of your viewers. Now, obviously, compared to our viewers, compared to our competitors, we are a slightly different company. We are not a general purpose IT services company. We focus on digital engineering. We focus on the aspects like product development, application development, cloud-based, application/infrastructure management, and bringing the tenets of AI to our customers. So from that perspective, we are more a modern application/product development player, and that is what is playing out very nicely for us. On the other side, we are engaging with our customers to understand how they are reacting in a weak macro environment for themselves and being a part of their revenue-oriented plans or cost reduction plans. So that's panned out very well for us, both in our existing customers and in new customers, and has delivered a significant order book, which was at $500 million plus for us in this quarter.
Okay, your total contract value revenues are at all-time high. What is the sense that you're getting from the ground on deal ramp-ups at present?
So look, we have been having good deal wins over the last several quarters. That is the basis for the revenue growth that we see as of today. Our pipeline continues to be healthy, and obviously we'll have to let the quarter span by, but we are confident of our revenue trajectory based on the deal wins that we've had over the last several quarters.
Okay. Also, your revenue from the top client has declined approximately by 6% QOQ after the continued growth of momentum in the last 3 quarters. But the total billed active customers remain flat sequentially. Can you tell us as to why is that?
So look, there is always going to be seasonality in certain customers versus the other. So we look at our customers as a portfolio of clients that we have. And if you look at our top client, the top client has done very well over the last several quarters. This quarter, we saw a planned ramp down of a particular program, and that is what contributed to the small ramp down that we have seen in this particular customer. But if you look at our overall customers, let's take a look at even the top 50 customers. The top 50 customers grew at 3.4% compared to the overall 3% at the company level. And if you look at the order wins, they are good forward-looking indicators of things to come.
Okay. And in terms of margin, you've grown your EBIT margin by 82 basis points, as well as you've added to your headcount in Q3. How did you manage that, and where do you want the end of the year to go in terms of margin front? And what kind of margin levers do you have in mind that you're planning to achieve?
Sure. So if we look at the quarter gone by, we expanded the margins by 80 basis points. This was on the back of higher utilization, lower travel expenses, and more of SG&A and other rationalization, the cost containment that we do on an ongoing basis. So this quarter benefited from these things. As we go ahead, we have very clearly said over the next several years, we want to expand our margins by 200 to 300 basis points. And that is based on optimizing our overall operations, right from our SG&A, which is roughly about 50 basis points higher. We compare the 9 months of this year versus 9 months of last year. The utilization, where we are at 81.5%, we intend taking it up 2 to 300 basis points. And then, obviously, we've hired a significant amount of leadership and built capabilities that should give us leverage over the next several years. So you should see margin improvement over the next several years, sequentially as we go ahead.
Right. Okay. So margin improvement in the next coming years. That's the outlook. Great. Talking about the merger of Capio Software, I hope I'm pronouncing that right, has been approved in this quarter. Can you tell me what are the synergies that you're expecting out of this merger?
Yeah. So Capio is an entity that we had acquired a couple of years back. So right now it is more of legal entities getting merged rather than any more synergies that we expect out of it. So from that perspective, it is an acquisition that has panned out very well for us, and this is just an ongoing activity.
Okay. All right. In terms of deal making, US clients have just about decided on their budgets for 2024, and I'm sure your conversations with potential clients have already started. What is the sense that you're getting out of them in terms of deal making? Like, is their decision making still delayed, or when will the discretionary spends return?
So if we look at our overall discussions with our customers, these are ongoing things. Obviously, yes, the December month is the end of the fiscal in the US, and we have been in continuous discussions with our customers. They are cautious about the macroeconomic environment. Having said that, there are discussions we have on their revenue enhancement and cost containment programs at large, and we have a fairly healthy pipeline with our existing customers as well as some good discussions with newer prospects.
Okay. Also, Sandeep, talk us through the rationale for the proposed stock split. I believe the shares with face value of 10 each will now be split into rupees 5 each, right?
Right. So in the quarter gone by, rather the board meeting over the last several days, there were two significant things that we announced. One was the dividend, which initially the interim dividend is announced in this particular quarter for us. So we announced interim dividend of 32 rupees per share. And the second part was the stock split. A number of our retail investors had been requesting us to split the stock to make it more affordable for them to participate in the journey. And that's the bigger rationale behind it. It doesn't change anything much on the financial side of it, but that's basically the rationale of it.
Okay, and in terms of your biggest business verticals, BFSI, healthcare, and software, high tech, how are they performing? Any signs of weakness in terms of software or high tech? And any green shoots in BFSI given the macro situation in US at present?
So look, in BFSI, there are certain dynamics that play out in the last quarter of every fiscal year from a US perspective. And we see traditionally, we and all our peers in the industry see some furloughs. So that panned out in the last quarter. Now, if we look at the current quarter and beyond, if we look at the BFSI side of it, there are certain things where the dynamics in the sector are playing out. The fact that there could be an easing of interest rates and that would reduce their net interest income, it's likely to add more on the cost pressure for them. And traditionally, whenever something like this has happened, offshoring has been at a more heightened clip in the subsequent quarters. There are other things like regulatory support around fraud monitoring, remediation, compliances, etc. as well, which are time bound. Things like ISO 222 by the end of 2025. So there's a bunch of things panning out. So we hope and expect that over the next 2 to 4 quarters, this sector will also start coming back and start seeing some good growth there.
All right. And my last question to you would be, can you give us an outlook for FY24 and 25 in terms of your top line and bottom line growth?
So we do not give forward-looking guidance, but if you were to look at the forward-looking indicators, the contract value that we announce, the order book that we announce, is a very good forward-looking indicator. So I would, urge you to look at the order bookings that we have done over the last several quarters, and you can understand from that the trajectory going ahead.
Right, so healthy order book is what is going to take you further ahead. That's awesome. Thank you so much, Mr. Sandeep, for taking out your precious time and speaking with us at NDTV Profit. It was a pleasure talking with you.
Hello and welcome to NDTV Profit. Joining us today is Mr. Sudhir Singh. He is the CEO of Coforge. He's speaking to us a day after the company's third quarter earnings, where the revenue rose 1.8% in constant currency terms. The EBIT margin expanded by 196 basis points to 13.5, while net profit jumped by almost a third to about 240 crores. Mr. Singh, welcome to NDTV Profit.
Thank you. It's a pleasure to be here.
Stellar set of numbers, as we can see. So that also in a seasonally weak quarter, sir. So can you tell us, has the seasonality affected you in some way? Has there been impact of the furloughs on your earnings in the third quarter?
It has been. This was a pretty tough quarter because furloughs this time were very, very significant. And if I were to even contrast them to just over the last couple of years, they've been significantly higher. The revenue growth has come largely on the back of the ability to execute against plans and also on the back of the large deals that we've been signing on a consistent basis. But furloughs did affect us through the quarter.
Okay. We also see that you have a very healthy order book. Correct me if I'm not wrong, you have clocked about 8th straight quarter of $300 million deal wins in the October-December period. So what does the executable order book look like at this point of time? And have the deals actually started to meaningfully convert into revenues?
They have. If you look at us, and it's not just 8 quarters, as you rightly said, of $300 million plus deals. What's always marked us out is when we do talk about large deals, we follow that up with revenue growth in the subsequent quarters. So as we look at our current pipeline, we feel very good. We feel very confident about the fact that the deal velocity is likely to sustain and that it will continue to drive growth for us. If you look at our results at the end of the first 3 quarters, year to date, end of the first 3 quarters, we are growing 14.7%. This is constant currency growth. This is all organic growth. So we're doing that currently off the back of the large deals that we have been signing. This year, we've already signed 8 large deals. Last quarter, quarter 3, seasonally weak quarter, we've signed 3 large deals. So I expect the large deal velocity will sustain given the pipeline that we're looking at right now.
What is the size of the executable order book, so if you can give us some color on it?
It's $974 million US. We're very close to a milestone that we've been looking at for a while now, which is $1 billion in terms of order executable. Our order executable also, interestingly, is not just signed orders extrapolated over the next 12 months. It is just a simple arithmetic addition of all statement of work signed. So if something's been signed only for 3 months, that's the only period that we add to. Currently, it's at $974 million, tantalizingly close to the $1 billion mark that we've been looking forward to.
Okay. So would you say that overhang of the slowdown of the US macros has now lifted? How's the demand environment looking now? So I'm asking from the point of view that this is the time around when US clients set out their budgets for the next calendar year, that is 2024. So what is the conversation? What are you gauging from the conversations that you're having from clients? Are the macros a thing of the past? Has the wheel of a slowdown, so to speak, lifted?
No, it's clearly not lifted. And our performance this year has come despite very weak macros. As we are planning for the future, we hope to turn in robust, sustained, profitable growth. But as far as planning is concerned, we are assuming that the next year is likely on the demand front to be a repeat of this year. And I want to underline this again. Our performance has come despite very weak macros. We do not see any material uptick in demand anytime soon.
Okay. But from that perspective as well, you're still maintaining your revenue guidance for FY24 as well as the EBITDA margins for this particular fiscal. What is giving you the confidence again? I think it's due to the wins that you are seeing so far. Will that have a spillover effect into FY25 as well, sir?
No, obviously it will. I mean, even if you look at this year, where fiscal year 24 that's going on, 3 quarters down, the macros were very bleak. The macros have been depressed, and yet we've turned in at the end of 3 quarters 14.7% CC organic growth. We believe our revenue guidance for the full year, and interestingly, we're one of the very few firms that gave a very clear, explicit range for growth at the beginning of the year, and we've been able to hold on to it and to deliver on it. So as we look at next year, large deals will obviously flow into revenue numbers and will drive growth next year as well.
Okay. Finally, as far as your human resources are concerned, what is the attrition looking like at this point of time? Are you going to be hiring this year? Because I'm asking because a lot we have heard from conversations from other IT companies, they are not giving us a very clear picture about the hiring plans for this year. So can campuses look forward to Coforge on their hiring season?
Oh, absolutely. They should and they will. We are a growth firm. We are crystal clear that the number one, number two, number three priority for Coforge is driving growth. We are confident about the fact that despite the weak macros, we will again figure out a path to growth as we did in the current year. So hiring will continue and hiring will be in line with our growth numbers next year as well.
All right. Thank you so much, Mr. Singh, for having this conversation with us. All the best for the year that's going to come for you.
Thanks. Bye-bye.
Thank you. Thank you, viewers, for tuning in. This is Tushar for NDTV Profit. Hello and welcome to NDTV Profit. You're watching the earnings review for Tuesday. Now we have IDFC First Bank, which reported its numbers on Saturday. Profit growth of about 18%, NII up about 30% year on year. I have with me the MD and CEO of the bank, Mr. Vaidyanathan. Mr. Vaidyanathan, welcome to the conversation. First question: would this gap between NII and net profit growth, if you can explain to us what happened here?
Our OPEX was a little higher than what it should have been, about 70 odd crores. So on a post-tax basis, let me call it about 40, 50 crores. And I think we probably did a little below par.
Okay. Just trying to get a sense of the elevated provisioning number as well. That's about 45%. I wanted to get a sense as to where this provisioning has gone in, because you mentioned that AIF was not a problem for IDFC First.
No, of course, we don't have any AIF exposure, but the provisions basically last quarter, same time, the recoveries from COVID write-offs were coming, while now that has ebbed off. So think of this as more normalized times, and even these numbers are like 1.3% credit loss to average book. We already guide for 1.5. So it's absolutely normal. You should expect these sort of provisions every quarter now, because that's the nature of the model.
Right, sir. On the net interest margin front, you've reported a 10 basis point upward move on a sequential basis. I just wanted to get a sense, you're already on the higher end of the NIM bracket. A 10 basis point improvement would mean that basically your lending yield is significantly higher than what the rest of the industry is working with.
Yeah, it's very simple actually. Last quarter we dropped our rates on savings accounts from 4% to 3% for up to 1 lakh rupees. So that obviously helped us in improving the margins. We feel it is stable here. We don't see any concern on this front. And the good thing is that this, with these margins, we're also getting very stable asset quality. So as a combination, it should be seen. Our gross NP is only 1.45% on retail, SME and rural, and net is only 0.5. So good asset quality with good yield. It's a good combination. I think it's a unique position to have in the industry.
Okay. During the quarter, you also gave a 5-year guidance. Now, guidance 1.0 was done. Now you're looking at the second 5-year period. Tell us a little bit about the numbers that you've listed out in your releases. 20% balance sheet growth. You're guiding for about 17-18% ROE, looking at about 1.5% on the gross NPA. I think 0.4%, less than 4.4% on the net NPA. How are you achieving these numbers?
We have put reasonably achievable numbers in our opinion, because what we've done is we've just assumed that the loan book will grow by 20%, which in this country growing 20 is not difficult. We're already growing at 25. In fact, to slow down to come to 20 if at all we come there. So, or as we go there. So that should be the loan side. Deposit was assumed only at 24.5%. So we feel it's easy to achieve because already growing at 40. So if we just meet these two numbers, the loan book at the end of 5th year, by our, let me say, informed guidance, informed guess, which is converting to guidance, is that we'll have a loan book of about 5 lakh crores. We'll have a deposit base of about 6 lakh crores, or 585. And then with that, we believe we'll still be growing at 20%. We believe a return on equity will touch 17-18%. And that's just, and we have fantastic intellectual property because it's a very unique bank and unique, very good model. So I think that sort of picture we are aiming to get, and the numbers are reasonable. We believe are achievable.
But you said that you would have to actually slow down from the current rate to match the guidance. I'm trying to understand where this is coming from. Is it largely because you're probably going to look at reshuffling the loan book a little bit?
No reshuffling, because we like all our businesses we're building, except that, currently growing at 24.5, our main focus is asset quality, asset quality, asset quality. We take big pride in the fact that our gross NPA is 1.5, net is 0.5. That's a bit of a, that's something we like to state, and we want that badge of honor. So for us, big focus is asset quality. And then we have guided this number. If we could do a little bit, maybe 1% or 2 more than that, we will definitely do.